This past week, the Federal Reserve did not raise rates, and long-term rates like mortgages declined to their best levels in a month. Let's discuss what happened in this week's Mortgage Market Update. On Wednesday, the Federal Reserve issued its monetary policy statement and decided to hold rates steady at a 22-year high. The main reason? Long-term rates have risen on their own as of late, which has caused financial conditions to tighten, thereby slowing the economy and doing the job of the Fed. The bond market loved the news, and the lack of tough talk during Fed Chairman Jerome Powell's press conference pushed rates lower. But the good news for bonds and rates didn't stop there. This week, the Treasury Department announced slightly less borrowing needed to fund the government for the last quarter of the year. They also stated they are likely to issue fewer long-term bonds like the 10-year note and 30-year bond. This was also good news for the bond market, as it meant less supply had to be sold, which means less pressure to provide higher interest rates or yields to attract buyers. And it wasn't all good news that helped bonds improve and push rates lower. On Wednesday, the Institute of Supply Management, or ISM, manufacturing report showed the 12th consecutive month of contraction. This tells us the manufacturing in our economy is not doing that well, and any bad economic news at this point is good for bonds and rates. And it wasn't just U.S. economic news alone that helped interest rates improve. Across the pond, many countries in Europe reported lower than expected inflationary numbers. Inflation is a major driver of long-term rates. As it goes up, so do rates. The opposite is also true. Additionally, the bond market is global, and as yields in other parts of the globe decline, so do ours. A couple of weeks ago, the 10-year note touched 5% a couple of times, but did not close above that key level. It has since retraced lower to 4.56% by the end of trading on Friday. If the 10-year note can remain beneath 5%, long-term rates like mortgages have an opportunity to stabilize and potentially improve further from here. Bottom line, it was a welcome sight to see rates improve. For rates to improve further, we must continue seeing more headlines like this past week. If economic data doesn't heat up again, the Fed may very well not hike rates again, which would indeed be terrific news. Now, looking ahead, we are going to watch and see if bonds can continue their winning ways and build on last week's nice interest rate decline. No major economic reports are set for release, but we do have a bunch of treasury auctions which in the past have pressured rates higher. It will be interesting to see how these auctions perform with rates having ticked lower. Thanks for spending a few minutes with me as we continue to work through this crazy market. Be sure to smash that like button, comment, share with others. I look forward to helping you bring loans to life, and have yourself a great week.